Creating passive income through investing is the ultimate end goal. And for a lot of people, that goal can easily be achieved by investing in high dividend paying stocks. So a quick refresher, a dividend is when a company earns money and instead of trying to reinvest that money back into the company and grow larger, they distribute that profit back to the shareholders in the form of dividends. And since dividends are taxed very favorably, that creates sort of a perfect storm for trying to create passive income for investors. And dividend investing has become very trendy in the last few years. YouTube titans like Graham Stephan and many, many more often advocate investing in dividend-paying stocks. And one of the most talked about dividend stocks out there right now is the Invesco S&P 500 High Dividend Low Yield ETF, otherwise known by the stock ticker SPHD. Now this stock offers an impressive 5.6% dividend yield, meaning for every $100 that you have invested in this company, they will pay you roughly $5.60 per year for owning these shares. But one of the big problems when it comes to high dividend paying companies is that usually it's either one or the other with dividends or growth. Either the company pays you a high amount of dividends, in which case now they have very little money to reinvest in the company, so the growth rate is very low, or they don't offer much in the way of dividends, but they reinvest that money into the company, and so the company is growing hopefully fairly rapidly. So typically it's sort of a one or the other. Some companies are a little bit of each. The overall S&P 500, I think it averages a little bit under 2% yield per year. But what if I told you that there's a way to get not only high dividends, but also high growth rates? Now that alone sounds almost too good to be true, but what if I blew your mind and told you that by owning this stock, that it was actually less risky than investing in the general stock market? Now, if that sounds too good to be true, welcome to the world of owning real estate through real estate investment trusts, otherwise known as REITs. Now, real estate investment trust sounds really complicated, but it's not. So instead of owning real estate directly, instead you own a company and that company owns real estate. So you're sort of one step removed from direct ownership in this real estate. Now, a lot of people out there know that owning real estate is the most tried and true, proven method to generating long-term wealth. The problem with real estate is it's expensive and not many people can afford to actually invest in it. And that's why these REITs are so fantastic. Instead of needing to save up tens or hundreds of thousands of dollars for a down payment on a property, you can buy and sell these REITs just like you can any other stock. Not only do these REITs pay very high dividends thanks to the monthly rent that these properties are able to collect, but they also have really high growth rates. We all know that real estate goes up in value over the years. So the first thing that we're going to talk about is the risk factor involved. Now, typically when it comes to investments, the rate of return that you get is directly tied to how risky that product is that you're investing in. For example, government bonds tend to be classified as one of the safest investments that you can invest in. But as a result of that, the returns, the yield is relatively low. Corporate bonds are a little bit riskier, but still very safe, so their yield is a little bit higher typically than government bonds. And then you can move down the chart to riskier and riskier products, maybe large cap stocks or small cap stocks, which are significantly more risky, but also offer relatively high rates of return. Now, this risk can actually be mathematically calculated by mathematicians that are much, much smarter than I am. And real estate is actually one of the safer investments, and yet at the same time offers one of the highest returns. So if you look at this chart, all the way up and to the left would be theoretically the perfect investment, offering a very high rate of return with almost no risk. And as you move to the right and down the chart, that becomes riskier and riskier with less returns. So theoretically, like I said, you want your investment product to be up and to the left. And you'll notice one that's sticking way up there is real estate. Now, real estate, like any other product, does go through cycles. We all remember the crash of 2009. But generally speaking, real estate prices are much more stable than general stock prices are. So not only are REITs relatively safe, they actually offer higher rates of return than the broad stock market does. So when it comes to rates of returns, the first thing is dividends, and the average REIT offers a very high 4.3% dividend yield. Now, obviously, some REITs pay a little bit higher than others. This is the industry average. But if you remember when we talked about the S&P 500, their average was under 2% dividend yield. So this is somewhere between twice as much or 2.5 times as much, somewhere in that area. So a significant increase in the amount of dividends you get. But as we said earlier, dividends is only one aspect of overall growth. Remember when we were talking about SPHD, that very high dividend paying stock that had 5.6% yield? Well, that yield sounds great, except it has almost no growth attached to it. So that dividend is more or less all you're really going to get. Now, this particular stock, SPHD, hasn't been around for too terribly long, but if we look back as far as we can at the 5-year average rate of return for this stock, you'll notice that the average return is only 4.96%. So while this particular SPHD pays very high dividends, that's all you're getting, which actually in the long run makes it a very suboptimal stock to own because the overall rates of return is not that good. But REITs, on the other hand, have phenomenal dividends and growth. So combined, the average REIT has returned about 12.87% annually. That's more than the general stock market has returned, which is about 11.6%. So for example, if you started at the age of 20 and invested $500 per month for the next 40 years until your roughly retirement age at age 60, if you achieved the broad stock market return of this 11.64%, you would have about $4.1 million in your bank account. Pretty good. But if we bump it up just slightly to that higher 12.8%, you would have over $5.9 million. That's almost 50% higher just by adding an extra 1% return to your investment. So to recap, not only is it safer to invest in one of these real estate investment trusts than it is to invest in the broad stock market through an index fund or something like that. It's not only safer, but it actually gets you a higher rate of return, both in the form of very strong dividends and growth potential. And you might be saying, well, that's just not possible. But one of the big factors is, and we all know, like I said, that real estate is just very intrinsically valuable by itself. It's a great investment product. But these real estate investment trusts have additional tax benefits that most companies don't get. And that's why they are consistently able to produce these high rates of returns. You see, when it comes to taxes, these real estate investment trusts are not taxed at the corporate level as long as they give at least 90% of their profits back to shareholders in the form of dividends. And it's this lack of being taxed at the corporate level that really puts these REITs over the top. Because if a company makes money, let's just say Walmart makes $1 billion in profit for a particular year, thanks to the Tax Cut Jobs Act of 2017, the corporate tax rate sits at about 21%. So theoretically, Walmart would pay about $210 million in taxes on this $1 billion of profit that they just made. But these real estate investment trusts don't get taxed that 21%, assuming they pay out the majority of their profits to shareholders. And that means that if two side-by-side companies each earned $1 billion, Walmart would have $210 million less to give to shareholders than a similar real estate investment trust company would have. So when it's all said and done, these REITs don't need to be anywhere near as profitable as a regular company to actually give the same high dividends that these other companies are doing, because they're not taxed at the corporate level. And that's why I love REITs. They're one of the safest and highest yielding investment stock that you can possibly own. In fact, if I were to show you my IRA, my individual retirement account, you wouldn't see Facebook or Google or any of those stocks in there. All I own in my retirement accounts are REITs. So that's going to wrap it up for us today, folks. Why investing in these real estate investment trusts is hands down the way to go. If you found this video useful, be sure to subscribe, leave a comment down below. I love hearing from you guys and your success stories. And as always, I'll see you all again next time. Thanks.